markets. I think that crude oil is better buy at $70, 135 for what's going on in the economy and the oil space, typically going into backwardation with spreads tightening, up year to date of 50%, and I think it's still in good shape. The next slide, Rajiv, shows a little indication why the curve is very steeply backwardated today versus 1 year ago where prices were lower and it was in contango. This type of structure gives me confidence to stay in the markets. Number one, it also gives me a positive carry on being long crude oil. When you're long, you roll into a cheaper contract and improve your average. To go to the next slide, I've been exploiting the oil and gas market because it's so cheap. XOP, these are some of the names in, whoops, that looks like those got switched there. I unfortunately left the XME names on the XOP chart. That is my mistake. The XOP is made up of the big oil companies, ExxonMobil, Chevron, then the big oil services companies like Schlumberger, then the big refiners like Marathon Petroleum, Valero, and it covers the wide section of the energy space. What's really interesting to me about the refiners in the energy space specifically right now is that you will see, if you chart refinery utilization, you will see that as refinery utilization grows back to the pre-lockdown levels and we start burning more gas, the refiners have in kind picked up and started rallying. So that's the third leg of the equity of the energy trade that I think get going, that started going now as the refiners. Up 66% year to date, and not backing up much. If you go to the next slide, Rajiv, please, XME. This is the metal space that I've been trying to exploit. Very interestingly, it double bottomed in 2015 and 20. It's breaking up through this really important level here. This is your steel companies, your metals and mining companies, your gold miners, your aluminum miners, and something that should perform really well in a controlled demolition of the dollar to try to support the risk complex. So I think XME is going to be one of the best performers going forward. I have latched on to this natural resources ETF for my subscribers. We bought this a couple months back. It's up 34% year to date. This is a great cross section of metals and mining and energy, and I think a great play for if you want to just stick to pure natural resources plays. My last pick, my next pick is the home builders section has taken off. This is both the retail and let's go one more slide. Right. The retail sectors of Restoration Hardware and Williams-Sonoma. I like this ETF because of that retail exposure that it has in it. I don't really invest in a lot of retail stocks, but the ones attached to the building sector have been on fire and on a tremendous bull run. So XHB, the home builders ETF, gives me some exposure to those. It also gives you exposure to the nail bangers, I call them, the home building companies that are out there building homes across the US that have got work on their pads as far out as they can see. So that's why these home builders have been rallying with tremendous, tremendous confidence in the space. I see a massive secular change here in the country of a lot good. We've got a lot more people working from home. We've got a lot more people putting money home office, home living, because there's more time there, and all of that unbelievable home builder rent.
Sorry, Tony, could you come a little closer to the mic? The voice is getting a little interrupted. Sorry.
Can you hear me okay?
Yeah, now it's better. Thank you.
Okay. If you go to the next slide, Rajiv, sorry, my other client. Rajiv, I've got BCom Grains is the next one. You look at this trend line that looks like it's breaking to the upside. We could potentially be coming out of a 30-year bear market in grains. I could see it happening as relationships between grain trading countries change, i.e. between the US and between China and Russia and Brazil. This could tighten up the supply chain. Currently, we're facing bad crop conditions in Brazil, not very good crop conditions here in the US, and we're seeing massive buyers from China and also India, which is interesting. I think that this is going to be a secular trend change, It seems like the time is right while other commodity inflation is taking place, while the oil markets back off, while the dollar is weak, metals are strong. I think that a lot of follow through investment. And if you go to the next slide, I've chosen to express that by buying DBA, which is the Invesco Deutsche Bank Ag Fund. They have long corn, soybeans, sugar, cattle, hogs, cotton, all kinds of things filter into the grocery bill that at this point are probably up quietly 20 or 30% since the lockdown lows and likely to go higher. This stabilizing type of inflation, food inflation. And so if we can in any way hedge our lifestyles or portfolio against that, I think that being long physical commodities in some way, shape, or form, especially food-based commodities, is going to be an important hedge to have on your books.